Hey guys, welcome back to another Radar podcast. This week, I'm going to be recording this alone again due to Artie's conditions with the Canadian wildfires. He's unable to get to a computer, so it is just going to be me this week. But let's start off with what happened in the market. So this week, and today being Friday, which is when this is recorded, was the big event of the week, Jackson Hole. Last year, this time, the market actually pretty much peaked and went down for its next leg lower. The trend was bearish at the time on the Nasdaq and on the S&P 500, and therefore price went down a lot easier. So we went into this week with a lot of individuals thinking that Powell would basically crash the markets from here, specifically saying that he was going to come out and be overly hawkish and just bring the economy back down. We had Atlanta Fed GDP now coming at 5.9% just the day before on Thursday. So everyone's really hyped up thinking, man, Powell's going to come in and tame this economy. Now, obviously, Powell was pretty hawkish, but it wasn't something that was taken too poorly by the market. The market actually held up quite well, with the Nasdaq closing up 1.57% over the last week, and long bonds actually closing up 63 basis points. But unlike the Nasdaq, long bonds are still bearish trend. So risk in the long bond space remains off. This is unfavorable, specifically because the trend itself is not supporting any type of bullish price action here. We can talk about the economy slowing, all the data points you want, but at the end of the day, price action on the long bonds are not supportive of higher prices. So we have to take that into account. Now, if price were to change on the long bonds, the first thing you'd want to see is price get back above mid-vamp and start climbing, similar to what we saw over here. Once we lost mid-vamp, as you can see, momentum shifted right back to complete bear, and basically the price started shitting the bed, and it has been doing that ever since we lost mid-vamp back in late July. Now, let's go over what's going to happen next week in the economic calendar. So on Tuesday, we have the Case-Shiller Home Price Index, and we have JOLTS. On Wednesday, we have GDP and the ADP employment report. On Thursday, we have jobless claims and the PCE, which again, everyone's focused on given that it's an inflation indicator. And then on Friday, we have the jobs report and ISM manufacturing index. So again, the jobs report is going to give us the unemployment rate. We're going to see where the economy has moved in the last month. Now, I want to start this out by saying our base case for the economy, which we've been chanting about pretty much since the beginning of the year, has not changed. The soft landing will continue until all faith in the hard landing is lost. Now, this is a very high-level summary of what we released in the last week called the compound landing. But I figure you guys still could use a little bit of an explanation in regards to the compound landing, specifically the stage that we are approaching being stage 3. So there are 4 stages in the compound landing. We have stage 1, which is lags, stage 2, which is policy, where we are right now, stage 3, which is normalization, and stage 4, which is the final straw. So we're currently at the end of stage 2. We've made our way pretty much across stage 1 and 2 throughout the first half, or the last 6 to 8 months. Stage 1 and 2, we're pretty much almost through stage 2 now. And stage 2 is where basically steady policy becomes the driver, right? Prior to this stage, we were in this economic environment where the terminal rate was very volatile. We had SVB. Everyone wasn't sure if the Fed was going to start cutting soon, hiking. The terminal rate was all over the place. That seems to pretty much been ironed out. I mean, we're seeing the terminal rate climb a little bit, but it's nothing like the volatility we were seeing in the last 6 to 8 months. So it's pretty much all about the duration at which the Fed remains restrictive, right? It's the duration at which they hold policy from here on out that will really determine where this economic cycle is moving towards. So typically, the recession does not emerge in stage 2, and it usually comes after everyone is convinced one is not going to happen, which leads us to stage 3, right? Stage 3 is normalization. This is the stage where you normalize avoiding the recession. Simply put, you're pretty much pricing out that recession and pricing in which everyone is hoping for, or most people are cheering about right now, the soft slash no landing scenario, which is accompanied by resilient growth. And obviously, that's being supported by the Atlanta Fed GDP nowcast, which we just had printing earlier this week at 5.9%. So obviously, stage three is heating up. Some would argue that we're already in stage three. I wouldn't make that argument just yet. I don't think we've seen that I don't think we've seen equity flows cycle through to where everyone's really convinced there is no recession on the horizon. Now, let's talk about what happens after stage three. After stage three, you get stage four, the final straw, which I explained earlier, and that's the real recession. That's the final, that's the end. And that's the recession that everyone understands. Growth down, inflation down, unemployment ticking higher. That is the final straw. And I think that, like all economic cycles, we will end with a recession of some sorts. Now, the issue obviously here is the duration between stage three and stage four, because that can be quite a while, and a lot of people might not be ready for that delay before the real recession. And we're going to talk about that more in a few minutes. But let's talk about what Powell said this week at the Jackson Hole Symposium. So, first thing he said was restrictive policy until inflation is sustainably lower. And then he also said persistent above trend growth could warrant further tightening. And then finally, obviously this is a summary, this isn't all he said, but finally, he did say that they intend to hold rates at a restrictive level until confident inflation is sustainably moving down to 2%. So basically, the Fed is coming out and saying they're not budging. They are going to play the game. They're going to play hardball if they have to get inflation back down to the target of 2%. A lot of people are worried that the inflation target may be lifted, obviously to make the Fed's job easier, not having to be, in terms of fighting inflation so restrictively for so long, they can kind of let go and say, okay, we can let inflation trend higher. Obviously, that is not the case. Powell made that very clear this week, again, as he has been over pretty much all of his speeches the last year. Now, we've also seen a bunch of Fed members come out and claim that the soft landing is their base case. Now, this is building up to basically roll us into stage three of the compound landing, where everything gets normalized. Now, the biggest factor of stage three of this normalization of the compound landing, right, is this idea that the economy can avoid a recession. So in a recession, typically inflation comes lower. So stage three does have a driving force on inflation. And how does that play out? So again, we know that growth and inflation feed off of each other, right? So understanding how this plays out is extremely important in terms of how you will navigate this stage of the cycle, of this recessionary cycle. So you typically have two types of recessions, right? You have the first type where inflation has peaked prior to the recession beginning. And on my chart here, we have the market radar official recession indicator, which you can find on TradingView, and it highlights the recessionary periods in red. And then we have inflation overlaid in blue, and the 10 and 2 year yield curve spread in black. So this way you guys know what you're looking at. But let me go back to the two types of recession. So we have the first type of recession where inflation has peaked prior to the recession beginning. And then we have the second one where inflation peaks during the recession, right? So for example, we went into 2020, this COVID, right? The economy was slowing down prior to. Inflation did not peak at any point prior to this recession. Similar type of scenario going on here in 2000, right? In 2000, inflation peaked prior to the recession. But in 2008 and in 1990, inflation peaked during those recessions. So it's very important we look at this. And I think it's hard to make the case that we're facing a situation where this stage three will drive an inflationary boom to new highs, right? So I think the tightening cycle is already being very extreme. And I think it's going to be hard to really push inflation to the new highs. But I do think we can get a bounce. And we've been very consistent in saying that it's very easy to get inflation down from 10 to 5 in percentage points, right? 10% down to 5%. But it's much harder to bring it down from 5 to 2. So again, I wouldn't be surprised if we saw some sort of bounce in inflation. Now, it doesn't have to be much, but some sort of bounce would not surprise me. So let's talk about the other supporting factors for inflation, at least the persistent level of it, right? It's the fact that stage 3 normalization of the compound landing prices out the recession. So currently the yield curve, as we can see here on the 2s and 10s, is inverted, and which is negative, right? It's negative / inverted. Now, what's going on here is the long end, if we scroll down, we look at the 10-year yield. The 10-year yield is 4.239 and the 2s are 5.08. So the long end is discounted to the front end, or the short-term interest rates, because there's an understanding that the Fed will not remain this restrictive forever, meaning rates will be lower at some point over this next couple of years. Rates will come down for whatever reason. If it's bringing down inflation, normalizing, getting back to the Fed target, whatnot, that's fine. But as stage 3 plays out, basically what stage 3 is telling you is it's pricing in the soft no landing, and it's telling you that the economy could or should operate or normalize at a higher level of interest. Again, if there's no recession here at 5%, the counter argument with the Fed being at 5%, the counter argument is the Fed is not restrictive enough, but maybe they're neutral. And if that's the case, why is the long end going to be discounted to the front end? Meaning there is upside risk on the long end, believe it or not. I didn't think we would see this type of upside risk basically play out in the way that it did, going back, 6 to 8 months. But again, we have to be a full cycle investor, and we also have to keep our hands on all of our tools, right? So bonds have never went bull, but the last time bonds were bullish trend was back in December of 21. So pretty much since over the last 2 years, bonds, or last year and whatnot, bonds have been bearish. There has not been a bullish signal in the bond market. And what does that mean? Well, that means bonds can technically continue to go down in perpetuity until something changes. So theoretically, risk is, as long as the trend is bearish on bonds, risk is to the upside in yields. Now, it doesn't mean that the 10-year is going to 10%. That's not what this means. What this means is the way stage 3 plays out in the terms of how it can basically appear or shows itself into the economy, or I guess I don't want to say shows itself, but emerges in the economy, right? It will drive this move in yields in a certain way. So it can, if stage 3 is accelerated, there will be a harsher move in yields, especially on the long end to the upside, versus if it's a slow grind. I was thinking it would be more of a slow grind, and basically we would burn out stage 3, but without actually getting that propulsion in yields. And obviously I was thinking that around here. Obviously we took no position given bearish trend. Remember, follow the tools, and yields pretty much have collapsed. So bonds have collapsed and yields have moved higher. So it does look like we're facing the scenario where we're going to get that more of a boosted move in the stage 3, meaning we're going to get this accelerated, or at least a pressurized move in higher in yields. So what that basically means, again, is the long end has upside risk compared to what many might think. Now, the problem is, if you normalize, stage 3 is going to normalize the economy at a higher level of interest, right? And this is where the problem emerges. So you end up erasing this long-term yield discount, which we were speaking about here with the 2s and 10s, basically re-steepening or reverting the yield curve. Now, a lot of people, it's not a lot of people. It's known that the reversion of the yield curve is the recessionary indicator. The problem is you need a reversion via a bull steepener where the front end is coming down, not a reversion because the long end is going up. That might trick some people into thinking the recession is here. That might invigorate some recessionary ideas, but in the end, the bear steepener, it will not drive the recession. It may start the recession, but it will not be the driver of the recession. So, anyways, back to where it happens if long yields go up. As if we're not going to face a recession, there's no reason the long end should be trading under the front end. Again, back to what I said earlier, you're normalizing this newer, higher rate of interest. So if if the Fed is not causing a recession at 5%, well, then why is the 10-year going to trade well below at 4%, right? And that's the theory that will cement across stage 3 and most likely drive the long end higher. Now, this is not essentially inflation driven, but it will be supportive for inflation, meaning inflation won't drive the move up in yields, but the yields may end up driving up a move in inflation anticipation. So it's kind of like one hand washes the other, right? Because growth isn't declining enough to materialize demand slowdown. So a move up in yields will signal that maybe more inflationary pressures are on the horizon. Therefore, then instilling confidence that we could get some further inflation, then therefore driving possibly further inflation. But that is a little bit ahead of the curve. Long story short, the normalization part, stage 3, is this idea that the economy can handle much higher and much more persistently, or I should say much more aggressive interest rates than previously thought. Now, there's a possibility that that can happen, but realistically, the issue with this and the way that this all ends is the long end going up in this manner adds additional restrictions to the economy to the point where things become unsustainable, ultimately driving the next recession, right? So the Fed's hiked interest rates. They're in pretty much the fastest rate hiking cycle in modern era. And there's so much lag that's built up and that's going to melt and flow through the economy that we haven't seen yet. So if we get this normalization of the yield curve where the long end starts treading higher, well, that's going to just add more pressure to the economy that we still haven't seen the effects from the Fed's policy leak in. So it's just kind of like a double whammy. But you guys are probably thinking, okay, that's cool, but like, what does this do for me, right? I would ask the same thing, and the answer is pretty simple, right? So how stage 3 affects the stock market, specifically stocks, is pretty straightforward. Stage 3 is the line to the slaughterhouse. Now, that road might be beautiful. There will likely be gains in the market, and it might be more than what you've already seen this year. Based on what I can see, we're at the tail end of stage 2, and we're just dipping our toes into stage 3. And if I had to give you guys a rough percentage, basically a ballpark, I'd probably say that we're at 85% stage 2 and 15% stage 3. Now, stage 3, like I said earlier, is the stage where the soft or no landing is completely priced in. And that means that the economy is pricing in an environment where it can pretty much function with higher than expected interest rates. Remember what I said before. Now, you guys might be thinking, well, that must be bad for the stock market. And that's not necessarily true, because instead it adds fuel to the fire as the whole reason many stocks have been basically gone the last 12 months, being due to higher interest rates and borrowing costs, that might not be true, therefore fueling a potential rebound in stocks. Now, I also, as I said, inflation could bounce. Things like commodities, let's take a look at commodities. They could heat up again. Might not be a lot, but they could heat up a bit. The problem is there's still bearish trend. So if you're looking for that commodity rebound, wait for the bullish trend. I'm not opposed to taking longs if this goes bullish, but the trends have to align. Until they do align, it's just not in your favor. Then obviously, after the market does cycle through and everyone's baked in, remember, we got retail, everyone and their mother's like, oh, we avoided the recession. It's going to be good. My YOLO calls are going to print. Then she dumps, and she dumps fucking hard. And that's when everyone gets caught off guard, because you can, but most of the time, retail is not going to accurately price out the recession pretty much any time, right? I mean, even in 2007, we had this idea. In September of 2007, there was news articles coming out from the Federal Reserve claiming the soft landing is near. Now, for some context, this is where September of 2007 was. If we take a look on NQ, This was right here. Okay. Obviously, things have gotten pretty bad after that rather quickly. Things got pretty bad after that rather quickly. But the idea of a soft landing is exactly what we want to see in stage 3. It's this idea that, okay, everybody is gearing up for no pain. And when everybody's comfortable, that's typically when people get hurt. Now, something will break at some point, as the cycle always does. We have economic rises, peaks, rollovers, troughs, and rises again. That's the economic cycle. So if you wanted to break this down into a simple and understandable take, look at it like this. We're basically on the teeter of stage 3 of the compound landing. To make sense to you, it's basically the inflationary regime. So think of our regime model: expansion, inflation, stagflation, deflation. Stage 3 is pretty much inflation. You can argue it's expansion, but it's really inflation, right? And that's masking the move to the final deflationary move. That's what that's doing. That's getting everyone all giddied up, saying, okay, the market can go up, everything's okay. And what I said earlier, in terms of I don't think we're even in stage 3 yet. I mean, 15%, right? I said we're in 15% in stage 3, is because there doesn't, obviously you can say NVIDIA all you want, but there doesn't seem to be a general euphoria in the market in terms of like, okay, we've certifiably moved around and have dodged the recession. Doesn't seem like we're there yet. Also, a lot of things aren't setting up for that stage 4 cycle yet. And we can see that in the economic data, regime models, and whatnot. So pay attention, follow the actual regimes. Me telling you it's inflation is just the nuance behind stage 3. It doesn't mean the regime model is printing inflation. It's just to give you a better understanding of what is actually going on here under the surface. This is a very tricky environment. A lot of people have lost a lot of money trying to play superhero here in terms of timing bottoms, timing tops, shorting bullish trends. I mean, we could look in the video. That was the name of the week, right? Everyone pretty much thought this was the bear market rally. This was the bear market rally. And some people still say this is the bear market rally. Thing is once it flipped bullish trend, all shorts off the table. And certainly once it did flip bullish trend, it was straight up from there. So we don't short bullish trends at Market Radar. It's not something that is productive. It's actually just painful. So I don't do it. Obviously, you guys are free to do whatever you want, but I just want to explain to you that stage 3 can act more resilient than you might think it is. Basically, from the bird's eye view, you might think, oh, stage 3, a couple months, we're in a recession by Christmas. That's not how it works. Stage 3 can last a lot longer than you think. Now, the Fed is a driver in killing stage 3, right? Remember, the Federal Reserve is going to want, as I said earlier, Powell is basically saying that he intends to hold rates at a restrictive level until he's confident inflation is moving sustainably down to 2%. By the time inflation moves down sustainably to 2%, and they're well over restrictive, they're going to be too restrictive for too long. That's the problem here. And that's the whole final straw moment of the compound landing. The Fed will not be able to thread the needle because they've come out pretty much, at this point, pretty much all the Fed members have come out and stated that they don't understand the lags of their own policy. So they're clueless on that front. Now you have them basically saying they're going to just hold restrictiveness until inflation gets down to target. Well, by that point, you would have had the lag cycle through the economy, which would accelerate that down move toward that 2% target. And you would have the overall restrictiveness of the Fed still being at that, or I should say the overall pressure of the Fed still being at that level of restrictiveness, also start to cycle through the economy. And that is going to basically push them over the edge at whatever point we do pivot. And everyone's going to say, who could have seen it coming? And that's pretty much how this works every single time. Now, obviously, this compound landing is a framework on how we can look at the current situation. I do expect the situation to unfold in a manner pretty much similar to how I've explained it to you guys, but new data can obviously come in and things can change. So that's why it's extremely important to keep the narrative, if it's the compound landing, if it's anything else you have, keep it in the passenger seat and let the data guide you. Let the tools guide you. The purpose of the narrative is to gear you up and emotionally prepare you for what's going to happen next. It's not there to give you this drive and this confidence to put on huge bets. We're not. This is not a hedge fund here. We're not Michael Burry here betting on the housing collapse or Stephen Druckenmiller trying to break the Bank of England. That's not what we're doing here. We're trying to catch the meat of the move of every cycle. We're not making YOLO bets, right? So if you, and that's why we make these narratives, to give you the emotional support to understand, okay, this is what's likely going to happen next. It doesn't mean that you need to follow it to a T. The data can shift, and that data shifting will shift the narrative. So sometimes in the stock market, the most unexpected things happen. And that's where the tools are important, because they will most of the time guide us and let us front run those moves, even when the narratives become stale. So sometimes the narratives can basically dry out, but the data shifts and the tools guide us some other way. We have to be willing at any point of any time to shift and move with the data. Thank you so much, guys, for listening to this week's Radar podcast. I hope to see you guys again next week. If you have any questions, feel free to reach out to us on our Twitter at The Market Radar, or go to our website at market-radar.com.